Hey everyone, welcome back to Corporate Decoder, the place where we shine a light on the financial secrets of big companies. And let me tell you, this latest filing from Putnam Mortgage Securities Fund has some interesting financial stories hidden within its pages, sort of like finding a diamond in a pile of mortgage statements. So, stick around as we decode what these numbers really mean for the company and its investors. Now, before we dive in, if you love getting clear, no nonsense breakdowns of complex financial documents, make sure you hit that subscribe button. And hey, we've got a fantastic community brewing over on our Discord server, linked in the description below. So come join the conversation. All right, let's get into it. We're looking at an annual shareholder report for Putnam Mortgage Securities Fund, and it covers the period from the 1st of October 2024 to the 30th of September 2025. Think of this as the fund giving its shareholders a detailed update on its performance, its costs, and what drove those results. First up, let's talk about costs. Nobody likes paying fees, but understanding them is crucial. For a hypothetical $10,000 investment in their class of shares, the costs for the year came out to $94. That might sound small, but it represents about 0.91% of the investment. It's important to see how these costs stack up. Now, for the juicy part, how did the fund actually do for the year ending the 30th of September 2025? The class of shares returned 5.59%. That is pretty decent, especially when you compare it to their benchmark, the Bloomberg US MBS Index, which returned 3.39% over the same period. So, the fund actually outperformed its benchmark. What helped them achieve this? Well, it seems that commercial mortgage-backed securities, specifically mezzanine bonds, really boosted their returns. The market for these bonds got better, meaning they became more valuable. Also, residential mortgage credit, especially something called credit risk transfer securities, did well because consumer finances were strong and fewer people were falling behind on payments. And finally, certain types of agency interest-only holdings also contributed positively. But it wasn't all smooth sailing. The report mentions that mortgage basis positioning, essentially how they managed their exposure to interest rate changes, was a bit of a headwind. When interest rates bounced around a lot, it hurt their performance in that area. They also used a lot of financial tools called derivatives, like interest rate swaps and options. Think of these like insurance policies or bets on future market movements. They use them to protect against risks, manage how sensitive their investments were to interest rate changes, and even to take advantage of certain market conditions. The report says that overall, these derivatives actually helped boost their returns, which is a good sign they were used effectively. Looking at longer term performance, it gets a bit more mixed. For the class of shares over 10 years, the average annual return was 1.24%. Now, that is not fantastic, especially compared to inflation or other investment options, and it was even lower if you factor in sales charges. The Bloomberg US MBS Index, for instance, had a 1.41% return over the same 10 years. So, for the long haul, they weren't exactly setting the world on fire, but they did manage to slightly beat their benchmark over that decade. Let's peek at some key figures. The fund's total net assets were a hefty $408,034,976. That is a lot of money being managed. The total management fees paid were $1,558,208. And get this, the portfolio turnover rate was a mind-boggling 10-13%. That means they were buying and selling investments at a very rapid pace, which can sometimes mean higher costs and potentially more risk. Now, they also have Class C shares, and these typically have higher fees or different cost structures. For a $10,000 investment in Class C shares, the costs were $170, about 1.66% significantly higher than Class A, and their performance wasn't quite as strong, returning 4.86% for the year, again underperforming their benchmark. This highlights how different share classes can lead to different outcomes for investors. Then we have Class R6 shares, often designed for specific types of investors. For these, the costs were a much lower $53 on a $10,000 investment, about 0.51%, and their performance was actually the best of the bunch, returning 6.15% for the year. This really shows how important share class selection can be. Turning to what they actually invest in, the portfolio composition is fascinating. The biggest chunk, about 30.7%, is in agency commercial mortgage-backed securities. These are securities backed by loans on commercial properties, but they have a guarantee from government agencies, which usually means less risk. Then you have a substantial 29.5% in commercial mortgage-backed securities and a whopping 139.7% in mortgage-backed securities overall. This is where the fund really puts its money to work, focusing heavily on the mortgage market. Looking at the overall financial health, the statement of assets and liabilities shows that as of the 30th of September 2025, the total net assets were $408,034,976. This is the net worth of the fund available to its shareholders. The statement of operations, which is essentially the fund's income statement, reveals that for the year, they generated $28,520,717 in investment income. Total expenses were $3,701,795, after some reductions leading to a net investment income of $24,818,922. That is a healthy profit from their investments. However, when you look at realized gains and losses, it tells a bit of a different story. They had a net realized loss of $12,167,516 from investments in unaffiliated issuers, though they did manage to offset some of that with gains from swap contracts. It highlights the risks involved in active trading. On the unrealized side, meaning changes in value without selling, they saw an appreciation of $6,453,847 from unaffiliated issuers. So, some investments increased in value on paper, even if they weren't sold. Overall, the fund's total investments by cost were close to $983 million, but their value at the end of the period was $976,181,737. This small difference indicates that their investments were generally valued slightly higher than their cost, but it is worth noting they were holding a lot of assets. Digging into the fair value measurements, we see a massive $927,806,288 in level 2 assets. This means most of their investments are valued using observable inputs, like market prices for similar securities. Very little, essentially none, fell into level 3, which would be investments where the fund uses its own assumptions to determine value. This suggests well-priced and liquid assets. Now, looking at their derivative contracts, the numbers here are substantial. They had interest rate swap contracts with notional amounts totaling $756,722,000 and $3,914,368 in other interest rate swaps. When you add up all those derivative contracts, the unrealized depreciation was a significant $2,215,634. This is an area where their risk management strategies are clearly at play, and it seems they took a bit of a loss on these in this period. And then there are the credit default swap contracts where they bought and sold protection against defaults. They had a net unrealized appreciation of $756,019 on these, which means overall they made a bit of money on that part of their credit derivative strategy. A key change mentioned is that as of the 1st of November 2024, Putnam Investments Limited merged with Franklin Templeton Investment Management Limited. This means that the investment professionals from Putnam Investments Limited are now employees of Franklin Templeton. This kind of restructuring is common in the financial industry, often aiming for efficiency and streamlined operations. For investors, it means a change in the team managing the fund, but the overall strategy seems to remain consistent. So, what is my take on all this? On the one hand, Putnam Mortgage Securities Fund had a decent year in terms of overall returns, particularly for its Class A and Class R6 shares, managing to outperform its benchmark. Their focus on mortgage-backed securities is clear, and they seem to be navigating those markets effectively, at least in the short term. The use of derivatives, while complex, appears to have contributed positively to their performance this year. Their investment in level 2 assets suggests their portfolio is generally valued using observable market data, which is a good sign of transparency and liquidity. However, the high portfolio turnover rate over 100% is a bit of a red flag. That level of trading can rack up costs and might indicate a more aggressive strategy that could lead to higher volatility, while their 10-year performance isn't stellar. It is important to remember that mortgage securities can be sensitive to interest rate environments, and the last decade has seen a lot of fluctuations. The fund's substantial use of derivatives also introduces complexity and potential risks that investors should be aware of. Overall, Putnam Mortgage Securities Fund appears to be a professionally managed fund focused on a specific niche within the fixed income market. While recent performance is encouraging, the fund's long-term returns and high trading activity warrant careful consideration. It is a fund that seems to be actively managed, trying to capture opportunities in the mortgage market, but as with any active strategy, there are inherent risks and costs to keep in mind. Alright, that is our deep dive into the Putnam Mortgage Securities Fund's latest filing. What do you think about their strategy and performance? Do those high turnover numbers worry you at all? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate financial decoded insights. And don't forget to join us on Discord for more discussions. Thanks for watching, and I'll see you in the next video.